When we talk about Ghost Week, we're not talking about superstition or catchy market slang. We're talking about something very real, very mechanical, and very dangerous if you're on the wrong side of it. This is the stretch of the calendar when liquidity quietly evaporates. Traders step away. Desks are lightly staffed. Volume thins out to a level where price is no longer governed by consensus, but by imbalance. And when that happens, markets don't move politely. They lurch. Most people assume low volume means low risk. They think nothing happens when everyone's on vacation. History shows the opposite. Some of the most violent and unexpected price moves occur precisely when participation is at its weakest. Why? Because markets are not driven by averages, they're driven by marginal buyers and sellers. When the crowd disappears, the marginal participant suddenly has enormous influence. A relatively small order under normal conditions might barely register. During Ghost Week, that same order can move silver dollars, not cents. Silver is especially vulnerable to this dynamic. It's a small market compared to equities or bonds, and it's heavily influenced by paper trading. Under normal circumstances, large players can lean on the price with futures contracts knowing there's enough volume to absorb the pressure, but when liquidity dries up, that cushion vanishes. The usual tools of control become blunt, unreliable, and sometimes completely ineffective. It's like trying to steer a ship when the rudder is suddenly too big for the water it's moving through. Now layer on the current setup. Physical supply is tight, inventories aren't exactly overflowing, and yet paper positioning still assumes calm. That's the contradiction Ghost Week exposes. The market looks stable because nothing is happening, but nothing is happening because no one is there. That's not stability. That's a vacuum. And vacuums don't last. They get filled, often violently, by the first real wave of demand that shows up. What makes this moment even more dangerous is complacency. Investors have been trained to believe that silver only moves when there's a headline, a crisis, or a central bank announcement. But some of the biggest moves begin without permission. They begin in silence. They begin when everyone assumes nothing can happen because nothing has happened recently. Thin markets don't wait for confirmation. They react to imbalance, and imbalance is already baked in. During Ghost Week, price discovery becomes fragile. Spreads widen, stops get skipped, gaps appear where trading simply doesn't exist. That's how you wake up one morning and find silver trading dollars higher, with no clean path back to where it was the day before. There's no gradual climb, there's no friendly pullback, there's just a reset to a level that better reflects reality. And by the time most people realize what's going on, the opportunity isn't gone, it's just far more expensive. This is also why waiting for January to see what happens can be a costly mistake. The groundwork for January moves is laid in December's quiet. When liquidity disappears, positioning matters more than prediction. If you're not already in place when the vacuum fills, you're not early, you're chasing. And chasing in a market like silver after a gap is a losing strategy more often than not. The real danger of Ghost Week isn't that something might happen. It's that something can happen without warning, without volume, and without giving you time to react. That's what thin markets do. They remove the illusion of control. They remind you that price is not democratic. It doesn't care how many people agree. It only cares about who shows up when no one else does. So when you hear Ghost Week, don't think quiet, don't think boring, think vulnerable, think exposed. Think of a market stripped of its safety nets, waiting for the smallest spark to ignite a move that looks impossible in hindsight but was inevitable in setup. Because in markets, just like in life, the biggest shifts rarely announce themselves. They arrive when everyone else has already left the room. If you really want to understand what's happening in silver right now, you have to look past the headlines. The headlines are always late, and more often than not, they're looking in the wrong direction. They talk about calm markets, fading inflation fears, or a lack of excitement in precious metals. But markets don't move on stories. They move on positioning. And the positioning in silver today is far more extreme than most people realize. On the surface, silver looks quiet. Price hasn't exploded, volatility feels muted, and mainstream commentary treats it as an afterthought. That's exactly what makes this setup so dangerous. Beneath that calm exterior is a structure that's badly out of balance, Large speculators remain heavily exposed on the short side, assuming that silver will continue to behave the way it always has: range-bound, manageable, controllable. That assumption works until it doesn't. And when it breaks fast. Commercial players, on the other hand, have been quietly reducing their exposure. That's not something you hear about on financial television, but it's critical. These are the participants with the best understanding of physical flows, delivery risks, and real-world supply constraints. When they step back, it's not because they're bored, it's because the risk-reward has shifted. They don't need silver to surge to know that leaning on it at these levels is becoming increasingly dangerous. This creates a market that looks stable but is actually stretched tight. Shorts feel comfortable because price hasn't punished them yet. Longs feel frustrated because price hasn't rewarded them yet. But comfort and frustration are emotional states, not market conditions. The condition that matters is imbalance. And imbalance doesn't resolve gradually, it resolves through force. What makes silver particularly explosive is the size of the market relative to the leverage embedded within it. A relatively small amount of new buying can force a disproportionate amount of covering. When prices start moving higher, shorts don't have the luxury of patience. They're leveraged, they're marked to market, and they're constrained by margin requirements. A move of a few dollars isn't just uncomfortable, it's existential. And that's how you go from a slow grind to a vertical move almost overnight. Meanwhile, physical demand continues to operate in the background, largely ignored by traders focused on paper flows. Industrial users don't care about narratives, they care about securing supply. Investors seeking protection don't wait for confirmation from the media, they respond to purchasing power erosion in their daily lives. All of that demand accumulates quietly, waiting for the moment when paper assumptions collide with physical reality. The headlines won't tell you this because headlines are reactive by design. They explain what already happened. They don't explain why it was inevitable. By the time you see stories about a surprise rally in silver, the real opportunity has already passed. The market will frame it as an unexpected event. But there's nothing unexpected about a rally that emerges from extreme positioning. That's not a shock. That's a release. This is where most investors get trapped. They wait for clarity. They want reassurance that they're right. But positioning extremes don't offer reassurance. They offer opportunity to those willing to act. Before consensus shifts, once positioning normalizes, once shorts have covered and exposure has been reduced, the easy money is gone. What remains is a higher price and a narrative that suddenly makes sense in hindsight. Right now, the gap between perception and reality in silver is wide. Perception says nothing is happening. Reality says risk is building beneath the surface. That gap is where the biggest moves are born. When it closes, it doesn't close gently. It snaps shut. So don't be fooled by the silence or the lack of excitement. Extreme positioning doesn't announce itself with fireworks, it announces itself with complacency. And when the market finally forces a reckoning, it won't ask for permission, it won't wait for headlines, and it won't reward those who assume they had more time. One of the biggest misconceptions in this market is the belief that price suppression is some permanent, unbeatable force. People talk about it as if it's automatic like gravity, always there, always working, no matter the conditions. But suppression, whatever form you believe it takes, is not magic. It's a strategy. And like every strategy, it depends on one critical ingredient: volume. When that ingredient disappears, the strategy weakens, sometimes dramatically. Under normal conditions, price pressure works because there's enough liquidity to hide it. Large paper trades can be absorbed, waves of selling can be layered, rolled, and recycled without immediately blowing back on the participants placing them. The market looks orderly, price behaves, and from the outside it appears as though silver is calmly trading where it should. But that calm is conditional. It relies on a crowded room with enough participants to keep the illusion intact. Ghost Week changes that environment completely. When volume dries up, the room empties. The same tactics that work in a liquid market suddenly become clumsy and dangerous. There's no depth to lean against. There's no crowd to mask intent. Push too hard, and instead of nudging price lower, you risk triggering the very move you're trying to prevent. In thin markets, control doesn't scale, it backfires. Silver is uniquely sensitive to this. It's not just smaller than most markets, it's more leveraged, more psychological, and more tightly wound. When volume is healthy, paper trading dominates the narrative. But when volume disappears, paper loses its power. Futures contracts don't consume metal. Algorithms don't take delivery. And when fewer players are willing to sell into weakness, price has nowhere to go but up. This is the part most people miss. Suppression doesn't fail because someone suddenly decides to stop. It fails because the conditions that allow it to function quietly vanish. Thin volume exposes every imbalance. Every aggressive sell order becomes visible. Every attempt to cap price risks creating a vacuum beneath it, and vacuums don't suppress, they amplify. In those moments, silver starts trading less like a derivative and more like a physical asset. Price begins to reflect scarcity instead of sentiment. That's when you see gaps. That's when price jumps levels instead of negotiating them. And that's when people who are confident in their ability to manage the market suddenly find themselves managing risk instead. What makes this especially important right now is timing. We're not talking about some distant future where conditions might change. We're talking about a window where participation is already thinning, where attention is elsewhere, and where any meaningful shift in demand can have an outsized impact. This is when the market is most honest, not because it wants to be, but because it has no choice. The irony is that suppression often creates the conditions for its own failure. B, keeping prices artificially low for extended periods, it discourages investment in new supply and encourages steady physical demand. Over time, that tension builds. And when volume disappears, there's nothing left to buffer it. The release doesn't come gradually, it comes all at once. That's why people are often shocked by silver moves. They ask, why now? The answer is almost always the same, because now is when the structure could no longer hold. The move wasn't created in that moment, it was revealed in that moment. The market didn't suddenly change its mind, it simply lost the ability to pretend. This is also why waiting for visible strength can be so dangerous. By the time suppression clearly fails, price has already adjusted. The easy entry is gone. What remains is a higher market and a narrative that suddenly feels obvious. But obvious is expensive. So as volume disappears and attention fades, don't assume nothing is happening. Understand that this is precisely when the grip loosens. This is when artificial pressure struggles to find footing. And this is when silver has a habit of reminding everyone that control is temporary, but reality always wins. Because when the crowd leaves and the noise fades, price stops obeying narratives and starts obeying truth. There's a reason January has a reputation in markets, and it has nothing to do with resolutions or fresh starts on a calendar. January matters because that's when money resets. Capital gets redeployed, mandates get refreshed, and risk that was avoided or postponed at the end of the year suddenly comes back into play. For silver, that reset has historically acted less like a gentle nudge and more like a repricing event. Throughout December, markets are distorted. Managers defend year-end performance, avoid surprises, and sit on their hands. Nobody wants volatility on their books when statements go out. That doesn't mean opinions disappear. It means they get deferred. January is when those deferred decisions hit the market all at once, and when silver is already tightly positioned, thinly supplied, and emotionally neglected, that wave of fresh capital can have an outsized impact. Silver tends to respond differently than other assets during these periods. It's not usually bought for momentum or fashion, it's bought for protection, scarcity, and asymmetric upside. When investors reassess portfolios at the start of a new year, they don't ask what worked last month, they ask what could protect them if the assumptions they're relying on fail. That question naturally leads back to hard assets, and silver, because of its size, reacts faster and harder than gold when that shift occurs. What makes January especially powerful is the psychological shift that comes with it. The pressure to conform fades. The need to explain short-term underperformance resets. Suddenly, managers are free to act on convictions they've been sitting on for weeks or months. That's when quiet accumulation turns into visible demand. And in silver, visible demand doesn't take much to overwhelm the market. Historically, this is when you see price gaps, not because something magical happens on January 1st, but because the market finally starts trading on reality instead of restraint. Levels that seemed resistant in December simply vanish. Price doesn't climb through them, it skips them. And the narrative always comes after the fact. Analysts rush to explain why silver moved, but the real reason is simpler. The market stopped pretending nothing mattered. This year, the setup heading into January is particularly fragile. Supply hasn't loosened. Positioning hasn't normalized. Physical demand hasn't gone away. What has gone away is patience. When new capital enters a market that's already stretched, it doesn't negotiate, it revalues. And revaluation doesn't ask for permission from those who assume they had more time. Another factor people underestimate is how January flows interact with low liquidity from late December. Moves that begin in thin markets don't reset just because the calendar flips. They carry momentum forward. A gap created during Ghost Week doesn't get filled just because volume returns. Instead, it becomes the new reference point. That's how you go from a quiet end to the year to a violent start to the next, without any obvious trigger in between. This is why waiting for confirmation in January can be a trap. By the time the move looks real, it's already well underway. Silver doesn't ring a bell when it reprices. It simply forces everyone to adjust. And those adjustments happen quickly because the market is small and the leverage is high. The pattern is clear, even if it's uncomfortable. December suppresses reality. January releases it. When silver enters that release phase with unresolved imbalances, the result isn't a rally, it's a reset. Prices don't move to where they feel comfortable, they move to where they need to be. So as we approach January, don't think of it as a new chapter. Think of it as a reckoning, a moment when delayed decisions meet real-world constraints, a moment when silver stops being ignored and starts being repriced. One of the most costly habits investors have is waiting for confirmation. It feels responsible, it feels disciplined. But in markets like silver, confirmation usually arrives after the opportunity has already passed. By the time price action looks safe, the risk has already shifted from being early to being late. And late is where losses are made, not avoided. Silver doesn't move in neat textbook patterns. When it breaks fast. It doesn't offer a series of gentle pullbacks to invite cautious buyers in. It gaps, it resets, and it forces decisions under pressure. Those waiting for clear signals often discover that the signal was the move itself. And by then, the market has moved to a level that no longer offers favorable odds. This is especially true in environments like the one we're in now, where liquidity is thin and positioning is stretched. Breakouts don't come with warning shots, they come when hesitation is most widespread. That's why the biggest gains tend to go to those who acted when it felt uncomfortable, not obvious. Waiting for confirmation is really just waiting for someone else to take the risk first. And when that happens, the market makes sure you pay for the comfort of certainty. It's important to be clear about what this moment really is. This isn't about making bold forecasts or throwing out dramatic price targets just to grab attention. Markets don't reward certainty, they reward preparation. What we're looking at right now is a setup, a convergence of conditions that historically precede major moves, even though the timing and trigger are never obvious in advance. The mistake people make is thinking they need to know exactly what will happen next in order to act. You don't. You just need to recognize when risk and reward have become asymmetrical. When downside is limited by real-world constraints and upside is amplified by positioning, liquidity, and psychology, the smart response isn't prediction, it's alignment. You position yourself so that if the move comes, you're participating, not scrambling. Setups feel boring before they become exciting. They feel uncomfortable because they require action when nothing seems urgent. That's why most people miss them. By the time the outcome is clear, the setup is gone, replaced by a new reality and a higher price. This moment isn't asking you to be right, it's asking you to be ready. Because the market doesn't reward those who guess the future, it rewards those who prepare for it.